Hello ladies and gents, Lex here, and today we are talking about 10 mistakes that beginner investors make. Now, I have made pretty much all of these myself during my time as an investor, so I am speaking from experience here, and I want to save you some time and money by listing these mistakes so you can avoid them because, well, smart people learn from their mistakes, and even smarter people like yourself, learn from other people's mistakes. In this case, mine. Let's get to it. Number 1, chasing trends. Investing in the hottest stock, investing in the hottest crypto, buying GameStop, buying Dogecoin, buying Shiba Inu, whatever is the hottest new thing that is riding the hype wave. That's usually the biggest mistake, is just buying that, because usually by the time that you've heard about it, it's already too late. It's already reached its peak. So buying in now is mostly nothing but downside risk. And let's face it, investing in things which are mainly driven by hype is a recipe for disaster and losing money, especially for the inexperienced investor. So avoid doing that, avoid buying things which are hot. Instead, you're better off looking at things which are not popular now, which have maybe come down in price a lot. And that's usually the opposite of what people end up doing. Everyone knows that you should be buying low and selling high. Instead, what most people are doing is buying high when the hype is high, when everyone knows about it, when it's the next big thing. And then when it crashes and everyone panics, they sell low. So you're doing essentially the opposite. What you need to be doing is looking into things that are cheap right now. For example, back in March 2020, buying petrol stocks like Shell, Chevron, BP, those stocks were really cheap because nobody wanted to buy gas. But look at them now. In my case, my position in Shell is up 80% and I'm doing pretty well. But buying it now, when the price is pretty high, probably not the best idea. Number 2, investing money you will soon need. This is related also to number 1, but investing money that you anticipate you might need in the short term is also not a good idea, because that means you might pull it out prematurely. So you might either incur losses or pull out just before the stock or the product in question starts to rise. So any of the money that you invest, make sure that you don't need them for at least a couple of years, so you have time for the market to do its thing. Number 3, which is again related to the previous point, is patience. Once you have your strategy, once you have selected the products that you want to invest in, you need to give them time to do their thing. A couple of years, 3, 4, 5, whatever your time horizon is, you need to leave the market to do its magic. If you're not seeing profits immediately, a lot of people get discouraged and they just sell. That can be a mistake, because if your initial thesis was correct, then probably the stock will begin going up, but by that time you're already out of it. So patience, patience, patience. Even if you are incurring losses, chances are, if you've selected good products, good companies, they will come back to a profitable level. Number 4, timing the market. And this is one of the biggest ones, and I've discussed it before in a previous video. You can find it in the annotations. But timing the market, trying to time the market, is one of the biggest mistakes that beginners make, and I've done this myself as well. Essentially, you cannot really predict in the short term what's going to go up, what's going to go down, and you are better off just investing straight away or using dollar cost averaging. And like I've said, I've discussed those strategies in the video, which is linked above. But not even the most experienced investors can reliably predict when the market is going to go down or up. So trying to buy at the lowest possible price and then sell at the highest possible price is borderline impossible. Don't do it. Just buy straight away, keep buying, And that's it. Number 5, no diversification. Having all or most of your money invested in a single company or a single sector can be potentially disastrous. For example, currently, people who are invested in the tech sector are in a world of hurt because of the situation with inflation and the Fed raising interest rates. Those stocks are not doing so well right now. If you have a diversified portfolio of stocks which are, for example, in the mining sector or brick and mortar or commodities, then you kind of balance out and you're doing better than an investor who's doing only tech stocks or only crypto. Number 6, not understanding the product or the company which you are investing in. This is also related to the previous point, but usually as a beginner investor or generally as an investor, you're better off spreading and hedging your bets in a well-diversified portfolio. Otherwise, if you want to focus on particular companies or particular sectors, you need to have a very, very, very good and clear idea of how that company is doing, how that sector is doing, what are the prospects for that sector, what is the profitability of that company. Some people that are really invested in certain companies even attend the shareholder meetings, they vote. So you need to be very involved in understanding the company, understanding the business model. So if you are picking individual stocks, which I would advise against, especially for beginners, you better do your homework. If you don't care about that stuff, like I said before, just diversify, and you will be fine. Number 7, too much turnover. That again also relates to the point of having no patience. Is basically, as soon as you see a company which you have bought not doing so well, you sell it and you go to the next product which you think will do better. And that way you keep cycling in and out of stocks, in and out of products, basically incurring a lot of commissions, a lot of taxes, a lot of fees, which is very inefficient and in the end hurts your total stock market portfolio performance for the year. You are much better off with selecting something and sticking with it instead of using all your hard-earned money to pay commissions and taxes because you just keep cycling in and out of products. So don't do that. Don't cycle too much. You don't need to be constantly buying and selling. What you need to be doing is just holding. Simple. Number 8, having no plan, having no goal. Now, if you want to begin investing, I think the first thing you should be making is a plan. What do you want to do with your money? How old are you? Is your horizon 10 years, 20 years, 30 years? Are you investing so that you can quit your job at some point and live off of your investments? Or do you love your job and just want to have something on the side? What is your goal? What is your risk tolerance? Do you want to invest in crypto, or is that something you don't understand? Have a plan of how you want to approach your investing. Otherwise, you will just be swinging left from right, basically giving in all the hype, being chaotic, spending money, not knowing what you're doing. You need to have a plan and you need to follow the plan. In my case, I know that the money that I'm investing, I will not need for the next 10, 15, 20 years. And I invest with a very, 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 very long-term horizon. Of course, I like to have some dividends on the side, just so you know you have something to live from. And that's it. And I am a very, currently at least, very risk-hungry investor. I have crypto, I have tech stocks, I have things which are considered risky and aggressive. But I personally am comfortable with that risk because I also want to expect a higher return. So you need to figure that out for yourself and make a plan. The best is, of course, to write it down. So when you are in doubt, in moments of doubt, you can come back to it. You can read what you wrote down and you just follow it step by step. Number 9, getting too emotional, which is again related to the previous point of having no plan. Because if you have no plan, chances are getting emotional, well, if the market sells off or if the market is flying high, you might do something that you will regret. In a panic selling, you might sell a stock which you intended to hold for a long term, or you might spend money on something that is just hot right now and you want to just make some quick cash, but it just goes down and you got emotional thinking, oh shit, I'm gonna miss out. FOMO, fear of missing out, is an emotional state that leads you to making brash decisions which can cost you money. Same things goes to panic selling. If there is some kind of a crisis and you sell a stock which you generally believe in, but you're just thinking, okay, I'm just gonna sell it now and then buy it at a lower price, but you never do, or it doesn't go lower, well, you've lost a position which you should have just kept. Don't let your emotions get the better of you. Just stick to your plan, or take a day off, cool off, get away from the computer, get away from the screen, get away from the markets, stick to your plan, invest long term, good to go. Number 10 might be the biggest mistake of them all, and that, in my opinion, is not investing at all. Investing and getting involved into personal finance is a very good way to take back control of your life, to have an idea of where you want to be in the future, and to work towards that idea and towards that goal. If you are not doing any type of investing, you are essentially only relying on your salary or potentially on your pension. If one of those things gets screwed up, for example, you get fired, you have no backup plan. Sure, you might have some money in the bank account, but really that money is being eaten away by inflation, which, as we know today, is very, very high. If you are just saving, you are potentially moving backwards. So you need to invest at a rate which at least beats inflation slightly to be moving forward with your financials and your savings, so you can build a future where you are entirely independent and free, which is something that I believe everyone should strive for. And I really do wish it onto everyone. And I hope that I do believe that everyone can achieve that. It's only a matter of planning, executing, and being consistent. That's it. Anyway, guys, thank you so much for watching. If you've enjoyed that video, like button as always appreciated. And yeah, we'll see you next time.